Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. What do we got going on today? Well, the market, the Dow's down about 200. NASDAQ, S&P are kind of flat, but it's Fed day. The Fed's coming out and talking today. Now, you know I don't like the Fed, but they are what moves the market. Nothing else matters. It's just what Jerome says. And Jerome's going to come out and talk to us today. What's he going to do? Well, here's my take. He's going to raise 25 basis points. All right, so what's the market going to do when he raises the 25 basis points? My guess is it's probably going to go up a little bit. It's going to have that head fake, but that's not the direction it's going. Once he starts talking, he may even already pull the market back down today. But sometimes you get a delayed reaction. Sometimes you get that initial rally, which could be today. We could rally up to, the 4,100 on the S&P, maybe pop our head a little bit above it, but I think tomorrow or Friday we'll come back down. So that's my take on the market. I think we're going lower. Now, so far in January, it's been a very hot month. We're up 6% on the S&P. And a lot of people think if the S&P has a good January, it'll have a good rest of the year. Now, that holds true a lot of times, but let's talk about one time it didn't hold true. Back in the dot-com days, where we had the dot-com bust, right? 2001, anyways, the market was up 4% in January. How did it close out the year? Down 26%. I think we're going to have a bad year. I really do. I don't think that this 6% rally is real. I think it's a sucker's rally. Be careful out there. I think the market's going to come in. That's my take. Of course, you may have a completely different take. All right, so let's get over to the real estate market. Now, the real estate market, always fascinating to me. Now, here's an interesting statistic. All right, so first-time home buyers are at a record low, 26%. Well, that doesn't sound too terrible. What's normal? Normal's about 40%. So 26% of buyers right now are first-time home buyers. Okay, now the age of the first-time home buyer has jumped up to a record high. The first-time home buyer, the age is now 36. That's at a record. That's the highest it's ever been. Now, in other words, we got the millennial generation postponing buying a home. Why are they doing that? Well, because they can't afford it. Look, at affordability has gone off the chart. Now, a lot has happened just in the last year. Now, a year ago, we still had rates about 3% for mortgages, and now they're at 6%. So a year ago, to buy the average price home, you had to make about $73,000 in household income to qualify to buy the average price home. But a year later, today, it takes about $107,000. So it went from $73,000 to $107,000. Now, if you go back to the beginning of the pandemic, we're up over 70% more to buy a home now than it was then. Now, home purchasing is based on income. Did your income go up 70% since the pandemic? Well, maybe yours did. In your area, it probably did. But most people know it did not. Most people cannot afford to buy a home. So the people that are buying the homes are the ones that sell the home. They sell a home and then they buy one. A first-time home buyer is getting kind of extinct. It's getting very rare. They aren't building first-time homes. They're building luxury homes. They're building bigger homes, the 1,200 square foot tract homes. They're not building them because, well, they don't make as much profit as when they build the 3,600 square foot home. So the starter homes are going away. The first-time home buyers are going away. Now, this is not good for the market. Now, don't get me wrong. This is just temporary. See, my view is that we're going to shift back. We're going to revert back to the mean. Now, to do that, it's going to take about a 50% drop just to get back to the mean. Now, we may overshoot to the downside when we're coming down, but this is just getting started. It's just getting started. We're down about 12% so far. But now I think we have a big problem. I think we have a real big problem. See, now what's really happening now in my area, we're down about 40% in sales volume. So it's almost half the volume that we were doing this time last year. It's just fallen off a cliff. The demand has fallen off a cliff because the affordability's fallen off a cliff. So the demand is down about 50%, where sales are down about 40 to 50% in many areas. Now, what generally happens is the prices tend to generally drop following the decline in sales. So you got the decline in sales down about 40, 50%, and we're waiting for the prices to drop. Now, I'll be the first to admit that a lot of people, well, they're just stubborn. The sellers are stubborn. They want to get what Billy Bob got. They don't want to drop their price. They have a choice. See, the buyer, they don't have a choice. They can't afford to buy at these prices. Even if they wanted to, they can't do it. But the sellers, they can. But the sellers, they're not in panic mode yet. They're sitting on a lot of equity. Look at it. I agree with that. Equity's at a record high. I don't know, $25 trillion in equity right now. I mean, okay, but here's the thing. That equity is going to get wiped out. People don't understand that. And now, why would you not sell when you have a lot of equity? Well, there's really no need, right? You're feeling rich. You're feeling like you have equity in the property. When do people sell? They sell when there's no equity. Well, they might not have a choice at that point. They may be forced to sell. You see, all this equity is going to get wiped out. It's going to go away. And when your equity starts to dwindle, that's where you start to panic. That's where, look at people my age, I mean, they're getting ready to retire, but they have no money. Where's their money? It's all sitting in the house. Well, what happens when the house starts to go down? When they see their equity start to erode, well, they start to panic. They go, hey, I better get out before I got negative equity. A lot of people already have negative equity, and those will become the forced sellers. There's going to be forced selling into the marketplace. That's just how it works. But I think we have a big problem. I think we have a big problem with, well, the whole financial system, really. You look at the U.S. dollar. Okay, now it is the reserve currency, and no reserve currency has ever gone into hyperinflation. But we're in jeopardy of hyperinflation. You see, we're making some really stupid mistakes. We continue to spend money even though we have this $31 trillion worth of debt, and we have this another 80, $100 trillion in unfunded liabilities in Social Security, Medicare, things like that. We keep spending on top of this spending. We don't have this money, so we keep the printing presses running. We keep printing new money out of thin air. But the rest of the world, they don't like this. They're looking at us going, well, wait a minute, we don't want those dollars anymore. Like Saudi Arabia, right? The Saudis, they came out and said, look, we'll take other forms of payment for oil. Now, this is unheard of. This is unheard of. You see, the reason the other countries need dollars is to go and buy oil. You see, we used to have an arrangement with the Saudis. It was called the petrodollar. Okay, Kissinger went over there, and anyways, he made the agreement. We'll give you protection from our military if you only accept payment in American dollars. Well, our military can't protect them anymore. They realized that when we pulled out of Afghanistan. We can't protect anybody. I hope we can protect ourselves, but we've really kind of gone downhill on that slope. So they feel they're not getting the protection, so they feel they can take payment any way they want in any form of currency that they want. And Russia, they're saying that they're going to accept gold for oil. Russia has a lot of both. They have gold and they have oil. And anyways, so they're going to accept gold as payment for oil. So the dollar's losing some relevancy. Now, this is a big problem. This is a real big problem. Those dollars, the other countries don't want them. See, they're not buying our treasuries right now. A lot of countries used to buy our treasuries because they felt they were valuable. They don't feel they're valuable anymore. And our treasuries are now paying 4 or 5%, but they might have to pay higher just to find some buyers. We're the only buyers of them, and that doesn't really make sense to me. It's like, don't we own the treasuries? Well, yes, we do. Well, would you like to buy them? Well, no one else wants to buy them. Well, why don't we buy them? But don't we own them? They're our treasuries. But no, we have the Federal Reserve. They'll purchase the treasuries. That's That's what they do. Okay, so we have a problem, right? We have this problem in the U.S. It's called debt, but that's not the only problem. We got this thing called pensions. Pensions are so underfunded. Why are they underfunded? Well, because the Federal Reserve kept interest rates at zero for the last 12 years. And the pensions, they couldn't make 7% on their money. So now they went into risky investments. What type of investments? Well, how about subprime car loans? Well, they bought those. Okay. Well, they're not getting paid on those. That's a problem. Well, what else did they do? Well, a lot of pensions, believe it or not, they went into Bitcoin. Anyways, you can Google this. I couldn't believe that the pensions are in Bitcoin. Well, Bitcoin didn't do so well for them. They bought up here at 60,000. We're down here 20,000. Didn't do that well, really. So there's a problem with the pension funds. Now, who's going to bail them out? Well, the taxpayer, of course, right? Taxes will go up to pay out the pensions. Well, the police and the firemen, there's not going to be enough money for those services anymore. So you're going to see those numbers dwindle down. We have this big problem. Look at a lot of people right now, they just don't have the disposable income anymore. They're living paycheck to paycheck, and this is going to cause a problem. The problem's going to come when the layoffs come. Why would there be layoffs, Mike? Well, if you aren't reading the news articles, the layoffs are already starting. 10% of the workforce in many areas, they're just getting laid off. Look, I don't have that many friends, but the friends I have, they work in the tech industry. And the conversations that I hear now, it's kind of funny. I don't understand exactly what they're talking about because I'm not a tech guy, but they're all looking for work. They're either worried about their job or they've already been laid off. So they have to go out there and they have to network with the other tech guys. Hey, can your company get me in? Here's my skills. I'm a coder. This is what I do. Can you get me a job? Well, no, we're laying people off. You see, there's this big problem. It's called layoffs. And that's how I know that the real estate market's in a lot of trouble. Look, the government will tell you that we got about 3.6% unemployment right now. Now, if you believe that number, that's fine. That's fine. But these layoffs, do you think that number is going to go up or down, that 3.6% with all these layoffs coming on? Well, I would say common sense will tell you that the number is going to go up 5, 6, 7, 8%, maybe as high as 10%. And that's where the problem is going to come into real estate. You see, that's where the forced selling comes from. Now, how do you know it's going to be a good time to buy? You see, I'm a real estate broker. I'm supposed to say it's a great time to buy because it always is, right? But how would I know it'll be a great time to buy is when that number goes from like 3.6%, let's say it goes up 6, 7, 8, 9%, and then it starts coming back down, 8, 7. When it starts coming back down, that's the time you buy. You don't buy when the unemployment number's going to be rallying. Look, at these layoffs are for real. Take my word for it. And it's just not the tech sector anymore. There's a lot of other sectors that are starting to lay people off by the hundreds of thousands. There's going to be hundreds of thousands of people laid off every month this year. Isn't that exciting? Well, it's going to be exciting for real estate. Going to create those opportunities, going to create the forced selling. But a lot of people don't believe that, and that's fine in your area. There's not going to be any layoffs. Everyone's going to keep their job. Prices are going to stay up, and that's beautiful, right? But in most areas, there's going to be these layoffs. There's going to be these people that can't afford mortgages. There's going to be this forced selling, and the prices will come down. Now, maybe we get a little bit of a bounce here because interest rates went from 7% down to 6%, and everybody's getting excited again. Now, and of course, the real estate agents, they're going, hey, you got to hurry up and buy. We're down to 6%. Hey, dude, it was just at 3% a year ago. We're up to 6%. We ain't down at all. Anyways, but they'll tell you that we are, you see, because they want you to buy. They don't have any business. They're going bankrupt. They can't pay their rent. Those poor real estate people. Now, I am one. It's terrible out there. A lot of transactions are not happening. Now, people think real estate agents get rich, but we're not really getting that wealthy because nobody's doing deals. Sure, when I make a lot of money when I sell a house, $30,000, $40,000, just like that. I don't really do anything. You all know us real estate people. We don't do anything. We just sit there and collect the big commission checks and drive the fancy cars because that's what real estate people do. Anyways, if you like this stuff, give me the thumbs up. Why not? It's Fed Day. Look, I think we're going to get a bounce, but don't get suckered into that. I think this time next week, we're going to be much lower than we are right now. Just my take. Get out there. Have a great Wednesday, everybody. I'm Tall Mike. Bye-bye now.